right, welcome back to Protect the Pile, the no-nonsense investment show where we cut through the noise with a panel of seasoned practitioners who play the game every day. We'll dissect the current landscape and debate the opportunities and help you navigate the markets using Hedgeye's risk framework and all our real-world experience, all focused on one goal: protecting and growing the pile. I am Patrick Kent, or RPK, of Hedgeye Asset Management. With me, as always, is Sam Rahman, portfolio manager and colleague. And as well, we have our guests today, are Josh Steiner and Drago Malesevic, who are both from the I guess financial slash macro slash housing team at Hedgeye. Is that about right?
That's about right. Yeah, you could probably add about four more things to that list, but that's about right.
We'll cover that as we go. But you guys are perfect on to be here to talk all kinds of topics. We're going to get to the credit card and payments discussion, which is going to be sort of our main topic today. But I wanted to kick it off. I'll just get some level setting in place here. We're recording on January 26th. The S&P 500 is sitting about less than 1% away from an all-time high. As Keith would say, all time is a long time. U.S. dollar has dropped more than 2% in just the last 5 trading days, which is a pretty big move for a currency that is as important as the U.S. dollar, and has now flipped a bearish trend on the Hedgeye framework. As a result, seeing precious metals hitting all-time highs as investors' affection for shiny rocks just does not seem to wane. Even with some of the big moves in the currency market, we've got volatility still relatively contained in the investable bucket, and sentiment's pretty neutral, which just says kind of despite all the currency action that investors don't seem particularly nervous. Volatility in both bonds and currencies remains pretty contained as well. That likely has something to do with the liquidity backdrop. Central bank policy, along with dollar moves, are pushing global dollar liquidity to, I calculated a 1 month annualized pace of 17% this morning. That's, I would say that's not a trickle, that's a fire hose. And China alone has added almost $1 trillion to dollar money supply in just the last month. So it says international equities outpacing the U.S. Over the last month, and suggests maybe there's life beyond AI and mega cap tech. The broadening of the market's been pretty clear with the Russell 2000 performance over the last few months, and is supported by revenue and earnings growth, which look really strong. Fourth quarter earnings so far, obviously with just a small percentage of companies reporting, but got top line growth for the S&P 500, 8%, EPS growth of 18%. I think the Russell's closing in on something like 20% plus right now on just a few companies that are reported. So that's it. That's my intro. So let's dive in. We'll kind of connect the dots and figure out what this means for protecting the pile. How's you guys doing?
Doing
Doing
well.
great,
Doing
man.
well.
Great. All right. I'll kick it over maybe to Sam. Sam, are there any topics that are top of mind you wanted to cover in the macro kind of portion of this? I
No,
just hit
you
on a
pretty
lot of
much,
it, so we can kick any of that around.
yeah, you pretty much covered a lot of the key issues. I think obviously we're in the heart of earnings season, so a lot of what you talked about could flip around, and we have mega cap company tech names reporting this week, so you could see some reversion of some of the existing trades we've seen, but I don't think it takes away from the underlying trends of a broadening of the market. Earnings growth supported by a lot of built-in stimulus that's in the pipeline. So I think the guy that's really tapped in and knows a lot about this stuff in terms of what's coming in terms of macro is Josh. So Josh, any sort of quick comments on your the key things you're looking for macro wise before we sort of touch on some of the financial stuff?
Yeah, I think the broader backdrop here remains largely as we've been sort of calling it. Inflation in rate of change terms continues to slow down. We'll get the January number in a couple of weeks, but we think it'll be pretty sharply lower than where we were in December. I think we're forecasting something like a 20 or 21 basis point further rate of change decel, which will bring the cumulative slowdown from September of last year to something like 50 basis points, which, in the span of about 4 months is not insignificant, obviously. On the growth side, you really have this sort of confluence of easier comps, tax-related tailwinds, The cessation of QT, the transition now to this sort of, I guess they call it RMP, but in reality, balance sheet expansion by the Fed, QE light, I think is probably the most apt description. And, bigger picture, I think the goal here is still very much one of looking to, run things about as hot as they can run going into, this fall ahead of these midterm elections. So, we're not really seeing any signs that growth is, doing anything other than either, hanging in there or picking up and inflation slowing down. So no change. I would note that, Drago and I were, updating the GIP model, late last week. And one of the things we added to it was the extension of the monthly quads through October and November of 26. And kind of interestingly, that does appear to be when the party may come to an end. So you can check me on that in a year if we go back in the time machine. But basically, we've got a quad three in October and a quad four in November, which really sort of lines up neatly, if you will, with
It
these
could be
guys
right
trying.
around the election, right? Just like sell the election day.
Yeah, pretty much, pretty much. And I guess it's not that much of a stretch either, right? It's like you pull as much activity into, the before times, the before election times as possible, and then you just end up with a pretty big void right thereafter, right? So
I mean, that's going to be a whole nother topic. We'll have to have you come back later in the year to just talk about the setup going into not only into the 26, but into 2027. Because it just feels like comping this quad one next year is going to be brutal. I mean, not to get ahead of myself. That's a ways away, but it does feel like a
yeah,
lot of things that have gone parabolic. They're going to be very hard to comp.
I agree with that. I think 27 and we'll obviously have much more detailed expectations than this sort of broad generalization I'm about to make, but I think 27 is probably going to be like you said, certainly very difficult on the growth side and has the potential for a boomerang on the inflation side for a number of reasons. So, could be in this sort of, somewhat deep quad three stagflationary, quagmire there for a while. But importantly, between here and certainly the summer, and even into sort of late summer, early fall, the outlook is really very supportive, very conducive of risk. And that's really what we've seen so far this year. So I don't want to sort of lose the forest for the trees there, and keep our focus to the appropriate duration.
Yeah, I mean that's why I focus so much on liquidity. Sam gets probably tired of hearing me talk about it because I do parrot it over and over again. But I've learned over the years from, skinning my knees that it never pays to be bearish when there is just more and more money floating around. With each day, if there are more dollars floating around to buy things, you do not want to be on the wrong side of that.
All money has to be somewhere, all the time, right? As our colleague Christian Drake likes to say. So, yep, if they're adding liquidity into the system, it's you got to have a pretty good catalyst on the short side.
Yeah. Any thoughts on I'm not to put you on the spot, but do you ever look at sort of the trueflation measure, and have you guys done any like a look at what that how yeah, if you have any sort of thoughts on its like efficacy at sort of either front running or at least coincident indicator relative to some of the other government
Yeah,
indicators?
it has some utility and then some shortcomings, as many things do. We do occasionally look at it. I look at it actually fairly frequently. Drago always scoffs at it. But basically, I think it's pretty useful from a directional standpoint, meaning, if it's slowing down sharply, if it's accelerating sharply. I think from a what direction, because remember what we're trying to do on the macro side, really more than anything else, is get that directional rate of change right. Right? Is it accelerating? Is it decelerating? Because if we get that right, we get the quad right. If we get the quad right, we're generally going to get most things right. And so in that respect, I think it's pretty useful. Where I think it's a lot less useful is if you were trying to use it to pin the tail on the donkey. If you're looking at the moves in that thing, they can be very violent and very abrupt, with very significant reversals too. So you've got to, it's a useful reference point, but you've got to know basically how to, I guess, how to filter the informational value appropriately. So yeah, I think it's useful, but you gotta use it the way it should be used, which I think is a little bit different than the way it's actually intended to be
I
used.
mean, you teed up Drago too well with that. I got to kick it over to him to at least like weigh in on his high level thoughts of why he would why he scoffs at it. So you gotta give us the counterpoint, Drago.
Oh, no, I mean, I think it's a useful, data series to obviously consult and, our sort of trying to kind of gauge, and sort of map the sort of underlying trend in inflation has kind of been like this big triangulation exercise as of late. And obviously, incorporating Trueflation, into that triangulation process, has its is incremental, is valuable to us as well. But I just find that, sometimes, in the past, it kind of overstates maybe the degree of sort of the kind of phase transition in inflation, whether that's, from a decelerating regime to an accelerating regime. I think for a time there, it was kind of referenced to sort of conclude that, we were sort of past the kind of and out of and clear of this sort of regime of kind of elevated inflation. And I just, didn't think like there was uh, really much merit to that kind of conclusion. And so, for that reason, I kind of somewhat, it's not that I discount the series itself, but often kind of, the commentary, surrounding kind of that data series, people sort of, I found kind of point to it and make conclusions, about kind of the future trajectory, future state of inflation that, I
Right.
don't think have kind of proven out. And I think in general, bigger picture, are kind of dismissive of this like, larger sort of fourth turning theme of like, ever more kind of debasement. So
Yeah.
that's
I
kind of
mean,
how I think about it.
no, that's a good point. I mean, it kind of gets to sort of dance between those two views. Like that's kind of what Josh was saying about that it has like it's a higher frequency directional move probably tells you something, right? And I'm assuming I haven't done a lot of work on the understanding the weights, but the big difference between a lot of these measures of inflation, because they can be all over the place depending on which ones you're looking at, right? Have a lot to do with what the weights are of the components and how they're putting it together. And so like I look at the things that probably are influencing that, right? Like gasoline prices are down year over year. So that if that depending on what the weight is there, I was looking at Zillow last week, like rents year over year are actually down slightly for just rental pricing. Is that food prices are actually down year over year. Keith's talked about this on the macro call, a show a bunch of times, like with potatoes being down 80%, like all these, some of these baskets of the overall commodity basket for Bloomberg, I think from the food side is down, or soft commodities is down about 12% year over year versus some of the other ones that are up, right? So like it seems like depending on what you're looking at, that's like influencing the the metric.
I think also the thing to remember is that, you know, Trueflation is obviously looking at price information, in real time or on a minimal lag, but doesn't actually have any forward element to it, right? So
Right.
obviously, one of the things we do is we have, both a quarterly and a monthly, probabilistic Bayesian forecast framework telling us whether inflation is more likely to be accelerating, decelerating each quarter, each month over the coming year. So, it's useful as sort of like a real-time indicator, real-time check directionally within, I guess, limits, but it doesn't tell you much about, where things are more likely to be in a month, in a couple of months, in a quarter, et cetera. So from a sort of, forward expectation standpoint, obviously there are a lot of limitations.
No, that's good. I mean, so as we said, the quad one setup here with growth accelerating, inflation slowing, I mean, it has led to that, what you'd expect, which is a broadening out across the market where we've seen, the Russell acting better, mid caps acting better. I mean, this has been a fascinating point to me that mid caps are actually really intriguing to me because of just looking at like the fact that if you look at forecasted earnings growth for the S&P 500 is like 14% for 2026 and trading at 23 times. Mid caps, 19% trading at 16 times. And then you get to the Russell and it's like there's like 30% plus growth because the comp is like insane, like that it's up against. But that's trading like 24 times right? The earnings. So it is interesting. There's sort of like mid pocket there that if things are really broadening out, these like medium-sized companies are going to continue to see strong numbers and we could see revisions moving up. And like you look at the move in Friday, almost said like I think Sam and I were back and forth on this on Bloomberg on Friday that like any like the market was flat, but only like 20% of companies were up. So it was actually the inverse. It was just like the counter trend move of like what we've been seeing, which is like the broadening out reversed.
Yeah, there's a few slides in our macro themes deck that go through these earnings outlooks for a few of the different cross slices. So like S&P 500, Mag 7, S&P 493, small caps, and I think one of the bigger sort of dynamics this year is basically that the earnings growth outlook for those mega cap tech names is about half of what it's been over the last year or two. And so obviously still very positive, but call it, in the mid to high teens versus where it had been, which was basically, at or near 30%.
Right.
And, it's tough to sort of argue that a multiple should expand if the growth rate's getting cut in half. And so, that I think is going to be sort of this anchor from a performance standpoint, sort of pulling down that, very heavy weight within the broader index. And then to your point, yeah, everything else or most other things actually are looking to see their earnings growth accelerate. Across large caps, X the Mag 7, mid caps, small caps, the acceleration is really nothing short of remarkable. I mean, these stocks, if you look at Russell 2000 net income for about basically 3 years, 2.5, 3 years, it was, negative anywhere from 10 to 20, 25% a year for years. And now, beginning in the third quarter of last year, at least running through the third quarter of this year, the outlook is for growth anywhere from 30 to 40%. So, just a real changing of the guard and old habits die hard. We sort of all have become somewhat confirmed in our bias toward those mega caps being sort of inexorable. But that's a lot of what we try to do, right? Is get these sine waves embedded within the sine wave, right? From a timing standpoint, right? Long term, there can still be a lot of truth there, but you can have certainly periods, months, quarters, even a year or more, where it goes very much the other way.
Yeah.
So
Dan, did you have
Jeff,
something?
related to
Yeah.
that, we've talked a lot in the past about technology changes and some of the secular dynamics of things that are going on within certain sectors. But financials, when you step back and think about some of the dynamic changes structurally that are going on to a sector that we in the past have always been seen as, very sort of old economy, cyclical, and not boring, but like just, well understood. I mean, some of the disruption that you guys are starting to see across the broader financial spaces is really, really interesting. So we'd love to get you and Drago to touch on, and because it ties in payments too, like some of the things you're seeing and kind of if you were to imagine a world in the financial sector 5 years from now, what could we see that we are sort of blindly ignoring right now in the sector?
Yeah, it's a great question, and actually, I think one that very few financials focused analysts tend to think about. I think that tends to, frankly, be like more often in the sort of realm of tech, maybe comms, but financials. There's an old joke in bank investing, which is 50% of owning a bank is the macro environment, and the other 50% is decisions undertaken by the bank 5 years ago. And so, there tends not to be a lot of, like you said, it's very old economy. The banking business has been around obviously a very long time, and it does change and it does innovate. Probably the more recent stuff that's kind of interesting is stable coins coming into the focus, and what sort of potential for disruption that might have. And obviously fintech has been around now for quite a while, and I think in some areas it's sort of delivered on its promise, and others I think it's been a disappointment. And I think it's like a lot of things, right? Like the devil is always in the details, and I think where Drago deserves a ton of credit because he's really rabbit holed a ton of this stuff, and frankly been right on it years before people have most people have been starting to figure this out, is that all that glitters isn't gold, right? Just because you're a fintech and you've got a super app and you claim to be disruptive, like it's not that easy, right? And we spent a lot of time fundamentally thinking through, like which of these businesses hold real promise, which are more fool's gold. And also, even within the ones that are looking pretty good, how do you get that timing right? How do you, pick the 2 quarters or 2 years when something's really going to do well, versus, when it's going to be a pretty lousy investment. And so we spent a lot of time on that. I think, bigger picture, like from an innovation standpoint, I think, I always think of Capital One as kind of an interesting example, right? So, Capital One, for those unfamiliar, I mean, this is really the company that sort of introduced risk-based lending, like democratized, credit access, credit availability, across the country. If you went back to the 1980s, this is kind of an interesting sort of topic because of this whole 10% interest rate cap discussion going on right now. But if you went back to the 1970s, 1980s, if you were a subprime borrower, you had a low credit score, credit availability was just not really a thing, at least, on an unsecured basis.
It's the days of layaway.
Yeah, 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 layaway. So, it's come a long way, and those guys were pretty innovative. And if you look at, I mean, same company still being run by the same guy, Rich Fairbank. Nigel Morris was there early on, he left, but you know, nowadays they're just sort of all about trying to basically build, a digital bank, right? And employing a ton of AI, kind of trying to meet the customer where the customer is, with these sort of like, retail, presences that are basically these like cafes, not these branches. And so in the traditional banking world, I think it's a lot about that. It's trying to, and it's funny with the branches because it's like, it seems to kind of go forward and backward, right? It's like, oh, branches are dead. And then it's like, well, actually, since everybody else is pulling back on branches, maybe we should open some new ones, right? And, these things come in waves and, the tide comes in, goes out. But, what's sort of happening in the background, right, is, this sort of integration, certainly from a payment standpoint, digital standpoint, the banks are very slow. It's taken them a long time to evolve and sort of, play catch up here. And that really left a big opening, a big window for fintechs to come in, right? Embrace the sort of digital native, millennial Gen Z, person who, in many cases has never set foot in a branch in their life. Basically, only interacts with a financial services provider via their phone, et cetera. And so, I think there was a big opportunity there. Now I think the banks are, playing a lot of catch up. I don't think it's as much of a runaway as it had been. So, I think, the areas of innovation are, they're there in financials, but I don't know that they're necessarily sort of compelling or promising, maybe as certain other areas of the economy, frankly.
Drago, what do you think about how, I've always found fascinating that how the adoption rate of some of these new platforms and technologies by the younger generations has been incredible. And the trick that I've always had, I'm sure Patrick would agree, is that as each of these technologies go through different phases, old versus new, or what we perceive to be old versus new, the knee-jerk reaction is like, oh, the old's going to die, it's going to get disintermediated. It's harder it's harder in other sectors too, but it seems like it's really hard in financials to disintermediate a well-established, very, very low-cost payment system with whatever the new shiny toy is, even if it happens to be, widely adopted by young people, because at the end of the day, it's the back end speed and cost that is the hard asset, that's the moat that everybody kind of never doesn't really think about, but actually is super valuable. But I'd love to get your thoughts on that and how to think about when is something really disruptive versus like, the old is actually still pretty much entrenched in terms of the infrastructure.
I mean, maybe to jump on that, Sam, too, I would say, yeah, payments has been like right behind healthcare to me as the area where people come up with like, oh, we're going to do this new thing. It's going to be, and you're like, yeah, try to that moving the existing infrastructure and ecosystem and getting it to change its habits is so hard that you're just like, it's an immovable object reaching a like, and an irresistible force, right? But yeah, I don't know if you want to take that, Josh or Drago.
Yeah. So I agree with that. The way I think about it is, obviously, we sort of began kind of this discussion with, this sort of kind of period of accelerating innovation within banking, right? Financials, banking being sort of like prime sort of these central to kind of financials, and obviously payments is integral to banking as well. And the kind of innovation we're seeing is related. And so the way I think about it is, a lot of this innovation in financials, you can't really it's all really being driven kind of by at a higher level of this sort of, persistent um, and long-standing overuse or misuse of kind of the fiat system, right? So you can't untie banks from the fiat system, right? Commercial banking is at the center of money creation in the economy. Um, and that worked for a while because, you go and you store your wealth in large part in commercial banking deposits. That's a form of money that kind of worked, maybe just like a grandchild who's maybe taken a penny a day from his grandmother's wallet or something. The theft or the debasement was subtle. But it didn't outweigh sort of the value you got. You had this sort of liquid, portable storage of your savings, and that worked. And you maybe earned some small kind of rate of return or some small yield on those deposits, and then that opened you up to this relationship with these banks. You could get credit from them and other things, and that worked for a long time until it stopped working, and that theft became sort of less subtle and more pronounced. And then people started seeking kind of out alternatives, and there's this sort of mass kind of chase for yield that took hold. And so what we're seeing with stablecoins, why are stablecoins relevant? They're relevant because we're all trying to kind of outpace in one way or another this sort of kind of melting ice cube or dilution of this big ledger, right? Of our savings. And you can explain, that phenomenon explains sort of this, trend of the democratization or the securitization of everything, Robinhood just kind of democratizing access to financial services. I think sort of that's behind a lot of the innovation we've seen in financials. And with respect to banks, this is sort of the big battle that's being waged right now between the crypto lobby and the banking lobby in Washington. It's over this Genius Act loophole as it pertains to the the payment of interest on stablecoin holdings, and that's directly, the threat of that is directly aimed at the commercial deposit base, commercial bank deposit base of 18 trillion. You have treasury reports going around saying that kind of, stable coins, as they currently exist with these interest loopholes, threaten to displace about 6 trillion, or a third of total commercial bank deposits in the economy. And that's the bread and butter of banking, right? Access to cheap, um, sort of sticky, deposits. And you ask, like, what are the implications of that? Well, how does credit how is credit adjudicated in like a stable coin proliferated world where you can just hold your kind of, your savings in a stable coin and earn a yield that does a lot better at keeping pace with this sort of aggregate, debasement or dilution than, let's say, like a traditional commercial deposit product. And then obviously, um, it's incredibly disruptive to, the profitability of banks. Um, Now, as it relates to payments, I think that, obviously the innovation around stablecoins is kind of primarily, sort of centered or geared towards the kind of the settlement aspect of payments. As you were, sort of alluding to, RBK, the payments experience for consumers is already, instantaneous and ubiquitous. And there's this, big system kind of trust that it's ultimately built around, and it's built to sort of service, us, the consumers, specifically speaking about the Visa, MasterCard, payment card systems. And that system, unlike maybe, let's say, the commercial banking system, has actually, functioned and delivered value to us as consumers, right? And so, I don't really see stable coins kind of, disrupting, Visa and MasterCard, the value proposition there, because, I do believe that they'll be able to sort of port their offering and their value, add onto sort of whatever kind of form, the payment sort of takes on in the future. What's really, been hurting payments, in addition to financials, is sort of this kind of, the crosshairs of being in the crosshairs of this kind of populist, or I guess like nominally sort of populist kind of moves from the Trump administration. And, it's kind of trying to, score small wins on the margin, like big picture, the economy was systematically deindustrialized. The fiat system was overused, misused. You had these kind of foreign wars in the absence of like any clear national security interest. And now, like you had this massive asset price inflation. Now there's this anxiety about the future of employment and sort of this service side economy, that's facing disruption from things like AI. And, we talk about inflation, right? Like, yes, food prices are down, but it's just the pace at which prices are still going up is lower,
Yeah, I
right?
mean, this is
Off of,
from the top of our discussion, right? We were talking
yeah,
like this is an election year, right? And
yeah,
affordability is, if we talk to the Washington analysts, affordability is one of the top things that the administration's most focused on and worried about. And so, just a level set for anyone who's not familiar with everything that went on before I let you continue on this, drug. I was just say, like, so it was about, well, everything moves quickly in the world of Trump. If we go back to like the beginning of the year, I think I originally scheduled to have you guys on. We were going to talk about the credit card companies, and I was like, it was probably on my list of like top picks for like the year, being like, these things like seem like they're set up. And then literally 2 weeks ago, we get Trump taking to social media with this proposal, right? That's like gonna a 10% cap on credit card interest rates for 1 year, which is pretty transparent what it's trying to do there, which was, I guess, supposed to go into effect 6 days ago, based on if we use the social media posts as policy dictatives. Um, so whether you consider that consumer protection or price control is, I guess, in the eye of the beholder. But on top of that, he was also looking for lawmakers, right, to support the Credit Card Competition Act, and in his like characteristically subtle way, it was like stop the out of control swipe fee ripoff, like so. I guess I wanted, as we continue this, let's get into what this means for these companies or what this could mean. The avenues they can pursue to even enforce this is kind of still a question mark, I guess, right? I mean, in revolving credit, the US at this point is what, 1.3 trillion in terms of balance, but that's way underestimates its impact because we turn this at quite a high velocity.
I'll cover the 10% rate cap, and I'll let Drago go over the Credit Card Competition Act. So the 10% rate cap, if this were to actually go through, and I don't know exactly what the sort of prediction markets would be saying on this right now, but I'd put it as still a very low probability. But if it were to go through, at least as sort of described in that True Social post, basically just capping for a year, essentially until the election, balances at 10% interest rate. Somewhere between 25 and 40% of Americans with credit cards would have their credit cards effectively deactivated and transitioned into what's called pay down only mode. They would no longer be able to use the cards for new purchases. Their balances would just simply go into full amortization, at that 10% rate, I guess. But I mean, if you think about the implications of that, right? I mean, the transition from paper money to plastic money has largely run its course in the U.S. at the consumer level, right? I mean, you don't see many people pulling out cash anymore to buy most things, right? It's mostly their card, whether it's going to the grocery store, buying gas, booking a hotel
Or what's
reservation.
linked on their phone, right? I mean, because they're using
Yeah,
the card, just ultimate card probably loaded into
yeah.
Apple Pay or
And
whatever, right? Yeah.
and essentially the only people who would be, you know, borderline unscathed by this would be like super prime borrowers, those with credit scores somewhere between, over 800 or over 750. But even they would likely have their wings clipped on their reward programs, because this would be so catastrophic for the industry. So basically, what you've got going on is a very weird sort of dance by the market where it's essentially ascribing a pretty low probability to a pretty catastrophic event, right? Like the impact for earnings, at least for this year, would be extraordinary. And the market's basically saying there's maybe a 5 or 10% chance of this happening. And that's enough that has put all these stocks into bearish trend for a period of time when they should have been among
Right.
the best performing.
If I trust Google Gemini, it says it's a 24% chance that this cap is like, which is probably
Yeah.
probably trending lower, not higher.
That's higher than I would guess, just given the power of the banking lobby within
Right.
Washington. Because this would affect, by the way, this isn't just Capital One. Basically tied with Capital One for the largest credit card book in the US is JP Morgan. So they are obviously extremely politically powerful across the House and the Senate, maybe less so within the White House, but this would be something that would need to go through Congress. They can't just issue an executive order and force it. I mean, they could try, but that one would end up in the courts very quickly and almost undoubtedly be injuncted. So, yeah,
Hey, Josh, isn't it first like there's a couple of banks that came out and said, hey, we're going to come out with a 10% rate card. But from what I understand, it's like it's the people that could actually get that card are going to be a really small
yeah,
subset. So it's more like a bone thrown at Trump's way more than anything
I mean,
else.
it's not just like offering a 0% APR, like, like the
yeah.
introductory period 0%,
Right.
like
Right.
Citigroup and I'm forgetting
Bank of
his
America. Bank of
yeah,
America.
B of A and Citigroup, both basically came out and said they were going to start issuing a 10% credit card. And I think the idea was obviously, just politically strategic. Hey, if we, give the Trump administration an off ramp here where they can, claim a victory by saying that, we were able to, get credit card rates down to 10%. Look at two of the biggest banks in the country. are now offering 10% credit card rates, that would maybe make the problem go away.
Yeah.
And, but to your point, yeah, they're like, good luck qualifying for that card. So, like the only people who would actually qualify for that card are, of course, the people who don't need it.
Yeah.
And frankly, wouldn't want it because it would be a no frills credit card. There'd be no
Right.
rewards program associated with it. So,
That seems to
Although
be every single policy issue right now is like, let's get an off ramp for this guy so he can just diffuse the situation and move
you can
on
get
to
a
the
headline
next.
win.
Yeah,
Yeah.
yeah, move on to the next shiny toy.
yep, yep. I mean,
Yeah.
look, I think to be fair, like I think the administration, you know, I think they deserve a little bit of credit. I probably wouldn't say a lot of credit for at least trying certain things because look, there are strong arguments to be made, right? I think that this term, you know, the cost of life has gotten expensive. I think Mike Green sort of harnessed, the sort of populist angst around that with those posts he put out. And, while I don't agree with all of the sort of, details and nuances of it, his framing, like I think he does, get to the heart of a lot of what is very real, right? Like, things, especially when taken in totality, from housing to healthcare, to higher education, right? Student loans, to cars, to groceries, and so on down the line. You put all those things together, and yeah, it has become extremely expensive for people to afford a lot of these things, and and I think the administration is at least acknowledging that is, they were sort of, I think for a brief window, they were trying to gaslight saying that, prices were down and that, this is all, a hoax and whatever. But, they've rightly sort of done a 180 here, acknowledged that, affordability is a problem. Now I would say they're kind of flailing a bit in terms of, just spitballing solutions at the wall, right? Like, on the housing side, as I understand it, Bill Pulte, and we know Bill, and we do like him, and we think, his heart's in the right place on a lot of these things. But he's put a list of something like 40 or 50 different ideas around housing affordability, ways to try to effectuate improvement in front of Trump, and it's basically just Trump's call on which of those to try to go with. So they're trying things. I just think that some of them are kind of aimed in the right direction. Some of them are like wildly misaimed or misdirected, and others are somewhere in the middle. And I think this 10% rate cap would blow such a hole in the side of the economy that the ship would sink within about 2 months. So
So,
that one
no,
would
that's
be gone.
that's great. And actually, to maybe to pivot a little bit to the bill too, then because that was part of this, is that you've got say Visa and Mastercard, which in theory wouldn't be that impacted, I guess, by a 10% cap. But I mean, obviously, if the velocity of all this slows down and there's not as much credit being extended, it would impact them, I guess, to some degree. But they haven't bounced at all. So clearly there's more worry about the swipe fees and stuff. So I guess I'm curious, maybe Drago, if you want to get into a little bit of the bill and like the what that implication is.
Yeah, I think the APR cap has some sort of second order, third order effects, like you mentioned. Obviously, I think credit spending's like 6 trillion in the US, so it's like a third of total consumption. And Visa and MasterCard, the sort of virtuous kind of network effects really start with issuance, right? That's why banks earn sort of the lion's share of the payment economics, those interchange fees. And that's what, funds a lot of the reward schemes. But what the other thing that funds the reward schemes is, less sort of financially, affluent people paying those high APRs on these credit cards and then subsidizing these, ultra luxury credit card rewards for people who ultimately don't pay those APRs and don't revolve. So, in addition to a huge kind of, downshifting of credit card volume, it would also collapse in large part, like a big part of sort of the kind of the rewards um, schemes that drive card spending and credit card issuance. But as it relates to the credit card Competition Act. So that's been something that's been, kicking around since like 2022. I think that's when it was first introduced. Um, kind of like a Durbin 2.0. So focused on credit cards rather than debit cards. And then it was reintroduced again in 2023. And now we have this, kind of third or second reintroduction, with the Trump Truth Social tweet. He's obviously kind of, calling out swipe fees directly. The original Credit Card Competition Act was sort of less focused on interchange regulation and caps and more on, forcing banks to enable dual routing like they do on debit cards on credit cards. Um, and I think like there's going to be serious implementation hurdles there from legislating that to implementing it and sort of um, kind of changing all of the existing infrastructure to be able to enable that on cards. But bigger picture, like, yeah, that might seem like maybe politically popular thing to do, but what it would ultimately spell is like the end or sort of the severe curtailment of rewards. And, I don't know how popular that is among sort of the, like among voters, right?
Right,
And
because all the loyalty programs, the miles programs for airlines, all this stuff would be impacted negatively, right?
Yeah, and it's totally in the theme of this like trying to score an easy kind of win. Um, Josh mentioned Pulte and the whole housing stuff. Like we saw this play out with the credit bureaus. It's like you're going after the cost of a credit report, to try to like ease housing affordability. It's kind
Right.
of, the wrong, thing to look at. And I think in the context of the Credit Card Competition Act, like it's important to recall like Durbin 1.0 itself, which was the capping of debit card interchange rates and the sort of enablement of dual routing. So, banks had to enable one other network that wasn't Visa or MasterCard on these debit networks. And this was supposed to kind of, lower costs for people. It was supposed to lower the cost of, debit card acceptance for merchants who would then pass
Right.
on those cost savings and it would make goods cheaper. And, what we ended up getting was like the loss of consumer debit card rewards. There's been countless sort of, postmortems done on this. Consumers did not end up paying lower prices. There was no pass through of these sort of theorized merchant savings. Merchants themselves, other than the really, really big ones, didn't save anything at all. Obviously, the interchange is just one piece of the MDR, the merchant discount rate. The merchant discount rate is ultimately set at the acquirer level. Um, and you all also had sort of this, explosion in bank account fees because, banks had to sort of make up
Right.
for this lost revenue source. And, there was the carve out for small banks. So if you had less than $10 billion in assets, you could still earn debit interchange and all that. And, that gave birth to sort of, the likes of, Cash App and whatnot. They benefited from that immensely. But then if you look at Visa and MasterCard, I mean, their debit franchises just, kind of persisted, and grew and really largely unaffected. And, I think we often bring up the examples of, Japan and the US being the only sort of unregulated credit card kind of interchange markets. And, you can look at sort of the growth of credit volumes, on a combined basis or Visa and MasterCard separately on a rest of world basis. And like, they're growing well. They're able to operate within highly regulated jurisdictions like Canada or Australia, just as they are, in the United States. And that's ultimately because it's like an alibi, you're this communication protocol that sits between like the consumer's bank and the merchant's bank. And, there's this very, intelligently designed kind of system of rules behind it all to make it function. And yes, in the US, issuers earn, a hefty interchange. But if there's a regulatory kind of barrier to paying out that interchange. Visa and MasterCard, that's their alibi. You can say, well, we can't really, you can't earn the same interchange. We can't set interchange at the same level anymore. Sorry, it's out of our hands. We'll continue to clip our, 10 basis point network fee that we do, which is, very marginal in the context of the value that they offer. And,
Right.
this is like at the heart of kind of all of this stuff. It's just this misunderstanding of kind of how the payment economics work and like how Visa and MasterCard make money. People conflate Visa and MasterCard with high credit card APRs and with 3.5% merchant discount rates, and
Yeah,
it's just
because
a lot more nuanced.
their logo is on all the cards, right? I see it
Yeah.
every day. I just assume they're the ones behind all of this.
Mhm.
Yeah, it's still crazy if you ask you do a random survey of 10 or 20 people on the street, ask them what kind of credit card they have, they'll tell you Visa or MasterCard, right? If you ask like, well, who's the issuer, they'll just look at you like
Yeah,
Visa or
yeah,
MasterCard.
yeah.
Yeah.
No understanding of this ecosystem, and quite frankly, I've even looked at it. I'm not sure my understanding of the entire ecosystem is that great when you look at all the arrows pointing in every direction, from the acquirer to the merchant acquirer to the issuer to the processor.
Yeah,
Uh,
I mean, Drago brought up a really interesting point about just unintended consequences, right? Like from these regulations. I mean, you put it's like a lot of things in life, right? You solve one problem and it causes others. And it's like, you know, Durbin capped debit interchange. Because if you remember back before then, there were debit reward programs and people used their debit cards and their credit cards,
yeah,
kind of interchangeably, like they were getting rewards on both. And then essentially when they passed Durbin, not essentially, all debit reward programs disappeared. And that just pushed people increasingly into credit. And, so you could sort of make an argument that, a lot of the sort of bad outcomes, people having, a lot of revolving balances, paying very high interest rates have been sort of like hastened along by
right,
that decision, many years ago. So, you got to be real careful when you implement these sweeping. We've talked. This is sort of tangential, but analogous, right? Like the creation of the private credit market as we know it today was a byproduct of the outcomes of Dodd-Frank, right?
yeah,
Like
of course. Yeah.
essentially, so
If you tighten regulation, we'll go where there isn't regulation,
yeah,
right? I mean, or there's less
exactly.
regulation. I mean, that's what's going to come out. I mean, ultimately.
Yeah.
Um, so maybe to close out this portion of the conversation, is it fair to say you both would think these are a tempest in a teapot, right? To use an old term, right? Like, I mean, just that this too shall pass, and we probably don't actually get any real movement on any of this.
I'd put a low likelihood, probably less than whatever that 24% number was, that we would get a 10% cap.
Yeah,
It would be so damaging, so significant that I can't imagine that Trump's advisors wouldn't explain to him very clearly how bad this would be, how damaging it would be, and if they decide to go through with that, even though it's only for a year, I mean, it would dramatically alter behavior. You know, people would have it would be really, really bad, really bad. And I think because it would be so bad, that's actually the reason it's so unlikely.
right.
So yeah, I would say it's a tempest in the teapot as long as it doesn't happen, which I think is unlikely to happen. If it does happen, it would be enormous. The impact would be enormous.
Yeah, I mean, to your point, right? I mean, this blindsided everybody when he put it out there, and I can't imagine that the lobbying phone calls haven't driven into overdrive to explain just exactly what would happen if they went through with this. So that'll feels like it's a social media post that just slowly fades into the background, and we sort of don't hear about it again for a while.
And
Um,
then on this CCCA, you know, my general sense with these things is like it's two very powerful lobbies in Washington fighting each other, right? You basically got the, payments and banking industry on one side, and then you've got the retail industry on the other. And their lobbyists, historically, that tug of war has tended to go the way of the banks and the payments companies. They tend to be a more powerful lobby. But both sides are powerful. And if Trump decides to make this like something he actually cares about for more than, 8 seconds, then yeah, you could actually see it gain momentum. But again, just in my opinion, like barking up the wrong tree, right? This is,
Well, and also like the odds of getting that done, because they would need Democrats to pass it, right? So I
well, the
think
funny thing
no,
about it is like it would do nothing for affordability, literally nothing.
right?
Retailers want it not because they're going to pass through those savings to consumers.
Oh yeah, it would just
Um,
be additional profit for them,
Yeah,
right? So
and,
yeah,
and so all you're doing is shifting, dollars out of the payments company's pockets into the retailer pocket, right? Like the consumer gets nothing from that. They could care less about it. They wouldn't benefit at all. So it's a stupid hill to die on. And it'll be a war between the sides of those
well,
lobbies. So
insofar as they need Democrats to pass it too. I mean, even if it's perceived as a win, do they really want to hand him a win like ahead of the midterms? I like that just seems like an odd thing to that it would even go forward. I mean, we're talking about the odds of a shutdown have already like spiked now, right? So I mean, the odds of them getting any kind of like any kind of bill through it would touch on this seems like an old stretch, but I don't know.
I mean, if you just as a final word on this, like when you really get sea changes is when you have these absolutely momentous events in history like the GFC, right? The GFC was so bad. It so wrecked the economy. It created its own populist movement. Elizabeth Warren was just, an absolute, lightning rod firebrand. Dodd-Frank sort of moved along like, all this stuff, CFPB was created, all these things happened because you had this titanic shift in the sort of the landscape, right? And there are big changes happening here. I mean, you're running an ETF that is designed to capitalize on them. But the point is that like, you know, there's not this like huge watershed moment for this kind of thing to sort of pass through, right? Like, no, I don't want to say nobody cares, but like, it's just, it doesn't have the sort of the
Could revisit all
political,
this in 2027 after we hit a quad four and things are a little messier.
yeah. I
Maybe
was going
one
to say it
last,
doesn't have the political heft
yeah,
to
yeah,
find
fair
its way
enough.
through.
The
So,
so the
Nicely
one question,
placed.
not know if it's a topic or it's more just a question. I'll close it out here. We don't spend more than a minute or two on it. But something that's been lurking in the background for a while in my mind has been the HELOC, like whole like home equity loan option. And like, I mean, if I look like the current outstanding balance on HELOCs, I think if I have this, you guys probably know these numbers better than me, but somewhere around like 300 billion. That way down from like where it was at the peak in '09, and like sort of well less than half of that level, despite home values and the economy having gone up dramatically since then. Um, so if I think of it, and since even COVID, like that balance has only grown up like about 30 billion, which is like nothing. I mean, compared to what's gone on in the economy and inflation and everything else. So are banks and consumers just like permanently positioned more conservatively toward this as a source of liquidity, or do we turn that ATM back on given the home equity balances that are out there?
yeah, so there's sort of two pieces to it. First, just to sort of put the numbers out there. So the total US homeowners equity right now is sitting at around 36-37 trillion dollars. By comparison, the total value of the US equity market is right around $69 trillion. Of that 36-37 trillion, about 16-17 trillion of it has come into existence just since 2019. So, a huge increase in the last 5-6 years. On the HELOC side, the peak in HELOC balances was 714 billion back right around the GFC, 2007, 2008. It got down to 317 billion in 2021, 2022. It's since risen to 422 billion as of the latest data. But maybe a better way of looking at it is not the dollars, because obviously
Right.
over time the value of the housing stock has appreciated
Yeah,
tremendously.
it's relative to the equity that's available, right?
Yeah.
Yeah.
So in the peak in 2008, 2009, the HELOC balance was almost 8% of total housing equity.
Wow.
Right now it's 1.1%. So two things would need to happen in order. So first of all, it is going up,
Yeah.
in dollar terms, although in percentage terms, not really that much. One is you would need rates to come down a lot, right? Because the average effective rate on a HELOC right now is around 7.25%. You would
Still cheaper than a
probably.
credit card, even with 10% cap.
It is. But it comes with it's secured and
Yeah.
it comes with the cost of doing business. If you run into hard times, then you could lose your house. If you run into hard times with a credit card, you just go
Just walk
and
away
get it
from it.
discharged. But so you would need rates probably to come down by a couple hundred basis points to really start to catalyze re-engagement with home equity borrowing. But the bigger piece is not even the rate side. It's that back in 2005, 2006, there was a pervasive mindset that home prices only ever go up, that you could not lose, that you could borrow equity against the house, and it didn't really matter because the house would just keep going up in value anyway and basically backfill that borrowing. People were using home equity not only for the traditional things like home improvement, but for all kinds of things, debt consolidation, vacations, higher education, cars even. They were using it for all kinds of things. And it was basically just a very different, belief system around what a house represented. And, I think the scar tissue from the GFC on the housing market are still, adequately, visible, that we would be pretty unlikely to get back to a state or a place where that was, likely to get back to anything like that. That being said, could you see 1% HELOC balance on, as a percent of the home equity go up to 1.5, 2%? Absolutely.
Yeah. Going
Yeah.
back to 8 is probably never
Yeah.
happening again, at least in my lifetime. But
I
like,
think the rates alone, if you were to get rates down another 150, certainly 200 basis points, you could probably get that 1% up to 2%. But to get to 8, you need a completely
yeah,
different like mentality around housing.
that's good. All right. Any closing thoughts or questions on that topic, Sam or Drago, before I move on?
Nope.
No? All right. I'll take your resounding silence as you don't have anything else to say on it. Here you go, Josh. That was perfect. You just nailed it. Nothing else to add. All right. Well, let's do some Q&A then. We have a couple questions I got. If we don't have a ton of time and I want to wrap this up in a few minutes, we'll take a couple of questions. I'll point this one to you, Sam. Why hold on to tickers that are bearish trend? Came in from somebody on X, responding to my plea for questions. So, yeah, what do you think?
Yeah, so the question I think relates to a couple of the really big mega cap names like Microsoft and Apple that have been bearish trend. I mean, the concept of risk management, which is what I use in the strategy that I run, is that I try to sort of ring fence myself with never being more than like plus or minus 3% overweight or underweight a position. Because just if you have a bigger bet than that, all of a sudden it's the single most important bet in your
Yeah,
portfolio. So,
right.
for example,
Your contribution to risk from that bet alone just suddenly
yeah,
swamps your entire
it's
alpha
asymmetric. So if
from
you if
anything
you
else.
if Microsoft, which is 6% of the benchmark, and I went zero weighted that, that would be the single biggest bet in my portfolio, and it would be a short bet against the index. Now, fundamentally, I think Microsoft's a fine company. I mean, clearly there's some short to medium term things that it's dealing with, but from a risk management perspective, and I had this conversation with Keith, and he kind of understood why when you're risk managing, and we're really talking about 4 or 5 stocks in the index, in the SP 500, that are more than 3%. So you really, out of the 50 stocks that I have in the strategy and the 500 stocks in the index, there's really only 4 or 5 names that require this unique sort of treatment, which is, okay, do I want to make this single biggest bet in my portfolio by being more than 3% underweight?
Right.
And so, when you think about it like that, that's kind of why, in this case of like a Microsoft, I'm 3% underweight the benchmark, but I still own it in the portfolio. So I think it's a good question that the person on X asked, and because people always see it in the portfolio and go, well, yeah, Keith said it's bearish and you still own it, but it's just a little bit more nuanced on that. Where
No, I think it's just really good, like, because it's really the difference between thinking about an index aware kind of approach, right? If you're
exactly,
benchmarking relative, then your contribution to risk, relative speaking, like from things that you're underweight and overweight, are going to make a huge difference
right,
to how your performance goes for the year. And if that's how people are evaluating you, then you don't want to have to like come down to all the decisions you made on selecting stocks just get swamped by this one stock decision, right?
exactly.
Which is all right, that was a good one. The other one I came in was talking about I was asking about allocating between ETFs. I won't talk about any specifics because we can't do that. I'll just use it more generally. Maybe I'll say, like, if you were thinking about allocating between a group of ETFs, you just want to look at kind of a first principles bottom up approach of what those things are giving you exposure to. So if something is more broadly diversified as an ETF, let's say for the sake of argument, it was one that was an ETF of ETFs that was in lots of different things, then you can sort of say, all right, that can be a bigger portion of your holdings than something else. If something else is a very sector or stock specific kind of approach, then you'd want to just think in terms of like what you want your equity exposure to be, and then put that in that context. Also, how hedged is it, or how conservative is the underlying strategy in that ETF? More conservative, it could be a larger percentage. More aggressive, that's up to you to sort of think about how you want your exposure to be there. All
Yeah,
right.
the thing I'd add to that
Yeah, well, go ahead.
is again, like you can use Hedgeye's macro framework to kind of, tilt the allocations across these ETFs based off what, the macro team and the process is kind of thinking about for the next, 4 to 5 quarters. And as we've talked about earlier, the team and the research is pointing to a very bullish outlook for maybe the next, 2.5, 3 quarters. So when you think about allocating across that, you probably want to be geared towards allocations that are more long only or levered to,
Yeah, you can be more aggressive because we're in
yeah,
an environment where you've got growth accelerating, inflation coming down, and which is
right, right,
growth accelerating is good for earnings. Inflation coming down is good for the multiple. And
right,
if you've got a broad liquidity environment that's supportive, then you can probably be slightly more aggressive in your allocations for at
right.
least for the next few quarters. All right,
And
that's good.
conversely, next year you kind of do the opposite. You kind of get more defensive. If the macro picture is more negative, you kind of get more defensive. And across the strategies we're talking about, there are hedge products, long short products, and also much more thematically hedged products that give you a lot of ways to protect yourself. And so I think the macro framework is a great way to kind of think about how to navigate that journey and how you want to weight, different, risks accordingly.
Good. All right. We're running up on time here, so I'm going to close it out. We'll do a quick, maybe round table on a fun question. Looking out I can see outside of Josh's window. There's plenty of snow up there in Rochester. So maybe a quick, if anyone wants to go around, quick, funny snowstorm stories from over the years. One of that comes up with my daughter will tell me, one of her quote core memories is that when she was probably like 4 or 5, is that February when the Boston area got belted with like 8 feet of snow in like 4 weeks. I mean, it became absurd. It was like every 3 days we had another blizzard coming through, and the snow just kept piling up. And I got so concerned about my roof. I was like, the structural integrity of the roof. I was like, I climbed up on the roof and was shoveling off the roof. And she's outside playing and watching me do this. And then I'm looking at like climbing back down, and I was like, well, there's like 4.5 feet of snow down there. So I just jumped off the roof. And she's like, thought that was the funniest thing and was begging me to be able to do the same. And I'm like, someday, when you're a little older and we get another this much snow on the ground, maybe you can jump off the roof. But out of it, it's got a funny one they wanted to share.
Yeah, that 2015 year was notable for me. Not really a funny story, kind of a tragic story with a good ending, with a happy ending. We were dealing with snow, ice dams, leaks, whatever. And the roof contractor we looked for to help out set the roof on fire. So we had
Ouch.
yeah, so we had a we were out of our house for almost at least a year and a half, maybe a little bit longer, rebuilding the house, the roof, the water damage, everything in between. The good part of the story was that we'd only moved into the house for 2 years, so we had really good insurance, and we had a chance to renovate the whole house. Um, so the moral of the story is do not get a roofer to get on your roof and blowtorch the ice off. That's moral story one. Moral of the story number one. Moral of the story number two is it pays to pay up for really, really good housing insurance. Get the
Oh,
gold-plated
yeah.
insurance.
It's good. I know Rochester's gets a fair amount of snow. What do you got for me, Josh?
Yeah, it's those stories actually reminded me of it's probably about, I don't know, 11 or 12 years ago, maybe 2014, 2013, somewhere around there. We had a ton of snow, and it was the same story. It was like we had like 3 or 4 massive storms within, like 2 or 3 weeks, and the temperatures were so cold, nothing melted. And at a certain point, the snow had, built up probably close to 3 feet on the roof. And I was like getting a little bit paranoid about like basically the roof like collapsing under the weight
Yep.
of the snow. And so, I did what any good research analyst would do. I started researching like, what do I do? And I ended up buying this like 40-foot snow rake that, it basically looks like something you would use to like, cross like a moat to storm a castle. And so I have that thing. And to this day, I've still never used it. It just sits in my garage because the most snow we've had is like a foot, foot and a half. And I'm just like, yeah, it's not worth it.
I've got one of
But
those in the garage. Comes out when we have snow like that right now because I have PTSD from the times I've had ice dams, but have water backing up in the house. So even if we just get a small amount of snow, I'm out there just like taking it off the edges. But Drago, you got a funny one that can close us out?
I'm Canadian, so I don't really have any kind of bookmarks of like storms. It's just been like a way of life but I will say, having kind of lived in Southern Florida for 4 years, and I'm actually up in Toronto now for some family stuff. And, there's this meme on the internet that you'll see of like, that guy growing up in Canada who shows up to school wearing like shorts, in like the middle of February. And I'm realizing, for most of my adolescent and early adult life when I was living in Canada, I never owned like a proper pair of winter boots. And I would just walk around in sneakers, and that dawned on me, coming from Florida and being like, oh my God, I'm going to be here for a winter. I'm going to like make the investment in like proper winter attire. So, in a way, I was that guy. Looking back on myself, I was that guy in shorts, in the middle of February walking to school. So, you know.
That's good. I like it. All right. Well, excellent. Thank you guys for joining us, Drago. Josh, this has been awesome. Thanks for the discussion. And for anyone who was listening, tune in for the next one. I suspect we'll probably be back on February 6th. I think we can get back to the normal schedule. We had the holidays moved one and then we had to cancel one. And so hopefully we'll be back on the 2-week cadence going forward. But in the meantime, you can follow me on Twitter/X at RP Kent. And Sam is at Sam of America, and I think is it Hedgeye FIG or one of the is the
yep,
financials or that you,
financial
Josh?
financial institutions group. Yeah, Hedgeye
There you
Fit.
go.
Yep.
All right. And Drago, I don't know if you have another one of your own, or is that it?
No, I'm operating in the sort of with some mystique right now.
Excellent. I like it. Just operating in the background. I like it. All right. So, you can see our bios on the Hedgeye Asset Management website. All right. I guess that's it. There's nothing else to add there. So, best of luck out there, and hopefully we'll see you on the next one. Thanks.